Good evening, students. Welcome back to the session on audit. In the morning, we started with this NBFC and we discussed certain aspects around the NBFC. We talked about the definition of an NBFC, what are the regulatory requirements in relation to NBFC, when is the registration required to be done for an NBFC. And then we also moved on to understand some of the items which the NBFC may have in its financial statements. And therein we also discussed about the prudential norms around the income recognition and around recognition of certain provisions which are mandatorily required to be done by an NBFC. We discussed that the advances of an NBFC are classified into certain categories, and depending on the category of the advance, provisioning is required to be done. Yeah, these were certain things which were relevant for an NBFC and which are very peculiar to an NBFC, or we can say to a financial institution, because you will see the similar sort of things in case of banking company also, or for banks also. So to a great extent we can say things are aligned in respect of certain provisioning requirements or certain prudential norms which are applicable to NBFC as well as bank. We also discussed as to what are the major differences between these two types of institutions. Now, as around these regulations which will require segregation of various advances into substandard, standard, loss or doubtful assets, this is something which is required to be done by the management, correct? So all of these things will be done by the management. Auditor is not required to do this, because where will all of these things be required? All of these things will be required in the books of accounts of an NBFC. When the NBFC will prepare its financial statements, therein all of these things will be required. So that's why when the auditor will start off, he will have all of these things available with him, or he should have all of these things available with him from the management of the entity. And in case any of these things are not made available to him, he will not be required to do this on his own. He will require the management to provide all of these details to him, on the basis of which then he'll work and get onto his audit procedures. And around the audit procedures also we had a discussion broadly as to what all items will be covered by the auditor. So it will be including the internal control systems, it will be including the review or the audit of the compliances or these regulations which are relevant to an NBFC. Then it will also require review of all of these provisioning requirements, all of these classification requirements which are applicable to an NBFC. Okay. Then I think the next topic around NBFC is classification of frauds, and which is again not uncommon. This is something which is very, very common, and this is again not something that you'll only get to see in case of NBFC. These are something you can find in any type of entity. For any type of entity, all of these fraudulent items can be seen, all of these fraudulent transactions can be seen. Important thing is for the auditor to catch hold of all of these items, if possible, through his audit procedures, but the requirement on the part of the auditor. And in case any of these events or any of these fraudulent things are brought to the knowledge of the auditor, then there could be certain reporting requirements on his part. Unlike in case of a company means which was a known financial institution. Because NBFCs are highly regulated, that's why there are certain responsibilities on the part of the auditor to report some of these items. So let's understand first of all classification of frauds by an NBFC. In order to have uniformity in reporting, frauds have been classified as below: misappropriation and criminal breach of trust, fraudulent encashment through forged instruments, manipulation of books of accounts, or through fictitious accounts or conversion of property, unauthorized credit facilities extended for reward or for illegal gratification, negligence and cash shortages, cheating and forgery, irregularities in foreign exchange transactions, any other type of fraud which may not be appearing in any of the heads above. So it means that these are the heads under which frauds will be required to be classified. That doesn't mean that only these frauds are required to be covered. There can be any other type of fraud and which may not be classified or which may be of a different nature other than the classifications which are available. So if there happens to be a fraud of any other nature or of any other item which may not get classified under any of these heads, A to F, then we take it to others. Similar to what we do in respect of various transactions or events. Now, as regards all of these frauds, we already understand about them. So that's why I'm not really getting onto the understanding of these types of frauds. Cases of negligence and cash shortages and irregularities in foreign exchange transactions, which are referred in D and F. So this one and this one. Okay, for these two are to be reported as fraud if the intention to cheat or defraud is suspected or proved. So they will be reported as fraud if those are suspected or proved. However, following cases where fraudulent intention is not suspected or proved at the time of detection itself. So one is when a fraud is detected, one is when the fraud is suspected, and the third is when the fraud is proved. Okay. So we are saying, however, in case of these types or in following cases where the fraudulent intention is not suspected or proved, that means at the time of detection itself, fraud will be considered and those will be treated as fraud and those will be reported accordingly. So let's understand what are those. Cases of cash shortages more than rupees 10,000 and cases of cash shortages more than rupees 5,000 if detected by the management, auditor, inspecting officer, it can be any inspecting officer, and not reported on the occurrence by the persons handling cash. So let's suppose there were persons who were handling cash, they did not report any such occurrence. So we are talking about the cash shortages. Okay. And we are only talking about the detection. So we also have certain directions. Directions are, you can say, some sort of regulations, which is about monitoring of frauds in respect of NBFCs. Those have been called as master direction, monitoring of frauds in NBFCs, directions. So NBFCs which are covered under these directions, having overseas branches, overseas offices, should report all frauds perpetrated at such branch or office to the Reserve Bank as per the prescribed format. So we are now talking about specified types of NBFCs which are covered under these directions and which have overseas branches or offices. So they are required to report all the frauds which would occur or which have been perpetrated at such branch or office. And where will those be reported? Those will be reported to the Reserve Bank. Now let's look at the reporting requirement. Reporting of frauds to the RBI as per Master Direction Monitoring of Frauds in NBFC. Frauds involving rupees 1 lakh and above. In case of frauds which are involving rupees 1 lakh and above. So therein the fraud reports should be submitted in all cases of fraud of rupees 1 lakh and above perpetrated through misrepresentation, breach of trust. We are saying all cases of fraud 1 lakh and above which are perpetrated through misrepresentation, breach of trust, manipulation of books, fraudulent encashment of FTRs, unauthorized handling of securities charged to applicable NBFCs, misfeasance, embezzlement, misappropriation of funds, conversion of property, cheating, shortages, irregularities, etc. So effectively you have seen that all the types of frauds are covered in a way. Yeah. Applicable NBFCs means the NBFCs which are covered are advised to furnish case-wise quarterly progress reports on frauds involving rupees 1 lakh and above. So they will be required to furnish quarterly progress reports. Okay, which are involving rupees 1 lakh and above. In the prescribed format only to the regional office of the bank, Department of Non-Banking Supervision, under whose jurisdiction the registered office of the applicable NBFC falls, and this reporting is required within 15 days of the end of the quarter. So let's suppose the quarter ends on June. So by 15th of July, it should be given. If for the quarter ending September, it has to be furnished by 15th of October. That means today. Okay. Next, fraud reports should also be submitted in cases where central investigating agencies have initiated criminal proceedings. So even in those cases, fraud reports will be submitted. Criminal proceedings have been initiated either suo moto or where the bank has directed, or maybe the bank has directed. And which bank is this? This bank is all about Reserve Bank of India. Applicable NBFCs, again means the NBFCs which are covered, should also report frauds perpetrated in their subsidiaries. So let's suppose NBFC has a subsidiary and the fraud is perpetrated in subsidiary, not in the NBFC itself, or its affiliates or its joint ventures. So even for those frauds, NBFC means in a way for subsidiary will call it as parent. So the parent entity will be required to report. Such frauds should, however, not be included in the report of outstanding frauds and quarterly progress reports which are referred in point number 1 above. And what is this point number 1? This one. Okay. Where the amount involved in the fraud is less than rupees 1 crore. So now we are looking at the amount less than rupees 1 crore. The reports in the specified format shall be sent to Regional Office of the Department of Non-Banking Supervision of RBI, under whose jurisdiction registered office of applicable NBFC falls, within 3 weeks. Within 3 weeks from the date of the detection of the fraud. NBFCs means all of these NBFCs are permitted to close the fraud cases only where the actions are complete and prior approval is obtained from the respective regional office of Department of Non-Banking Supervision. Means without their prior approval, these cases of fraud cannot be closed. So they have to be kept as active. Another category. So in the first category, we discussed about frauds involving rupees 1 lakh and above. Now we are talking about frauds committed by unscrupulous borrowers. Frauds committed by unscrupulous borrowers, including companies, partnership firms, proprietary concerns, and or their directors, partners, by various methods, including the following. Fraudulent discount of instruments. So at times certain instruments are discounted with the NBFCs, which may be fraudulent. Fraudulent removal of pledged stocks. Disposing of hypothecated stocks without the knowledge of NBFC. Inflating the value of stocks in the stock statement and drawing excess finance. Diversion of funds outside the borrowing units. Lack of interest or criminal neglect on the part of the borrowers, their partners, etc. And also due to managerial failure leading to the unit becoming sick, and due to laxity in effective supervision over the operations in the borrower accounts on the part of the NBFC functionaries, rendering the advance which is difficult of recovery. In respect of frauds in the borrower accounts, additional information as prescribed should be furnished. So in case of borrower accounts, what are the borrower accounts? The person would have borrowed funds. So that is all about advances which are given. So therein the additional information will be required to be furnished. Frauds involving rupees 1 crore above. Now in this case we are looking at first of all frauds which are involving rupees 1 crore and above. Now in this case, where the amount is rupees 1 crore or above, means under the fraud case, reports in the prescribed format shall be sent within 3 weeks. Within 3 weeks, reports will go out within 3 weeks from the date of detection of fraud. And please remember, this is different from what we have discussed in the first category. To the Central Fraud Monitoring Cell of RBI, and this will also go to Regional Office of Department of Non-Banking Supervision of RBI, which we just discussed. So it will go to two parties, Central Fraud Monitoring Cell and that regional office. In addition to the requirements given above, means in addition to this, applicable NBFCs shall report the fraud by means of a letter addressed to the Chief General Manager in charge of the Department of Banking Supervision of RBI Frauds Monitoring Cell, Central Office, Bangalore, and a copy endorsed to the Chief General Manager in charge of the Department of Non-Banking Supervision, RBI Central Office, within a week of such frauds coming to the notice of the applicable NBFC. So in addition to this, so I'm saying this reporting will be required, plus this reporting will also be required. So this will be covering A plus B, means all of these reportings will be required to be done by the NBFC. Now as regards this letter which will go out, which I mentioned in point number B, the letter shall contain brief particulars of the fraud, means about the fraud, as to what is that fraud. Amount involved, what is the amount involved? Modus operandi in brief. Name of the branch or the office. Names of the parties which are involved in fraud. So you can say a brief description of all of these things are coming in. If they are proprietorship, partnership concerns, they are private limited companies, names of proprietors, partners, directors, names of the officials involved, and whether the complaint has been lodged with the police. This is also required to be done. That means a copy of this letter should be endorsed. Which letter? This letter. We are talking about this letter, and same letter we are referring over here. Same letter is referred over here. So a copy of this letter should be endorsed to Regional Office of the RBI Department of Non-Banking Supervision. Next, cases of attempted fraud. All individual cases involving rupees 25 lakh or more should be continued to be placed before the audit committee. And in fact, this is not only limited 25 lakh. So even if the amount will not be involving 25 lakh, even if it is less than 25 lakh, you will see these cases being discussed with the audit committee. Okay. So now we have this checklist which captures the points which may be covered in relation to audit of NBFCs. Okay. These are some of the generic points on which you can just have a look. We'll cover anyways all of these procedures separately as we move forward. But this checklist will help you to understand as to what all procedures you can plan in respect of any type of NBFC. Moving further, about the duties of the auditor. So let's understand what are his duties. Compliance with the NBFC auditor's report, RBI directions. Directions of RBI have increased considerably, and this has increased the responsibility of the auditor. A very onerous task of reporting to the board of directors on certain specified matters and to the RBI on an exception basis has been imposed upon him, auditor. So that means auditor will be having this task of reporting to the board of directors on certain specified matters, and auditor will also be required to report to the RBI on an exception basis. Okay. This reporting requirement is in addition to the reporting requirements prescribed under Section 143 of the Companies Act. So if you remember, under Section 143, an audit report is required to be issued. You remember? A detailed audit report covering various particulars. Then we also looked at this IFC, CARO, etc. So auditor will be required to issue those audit reports. These reporting to the board of directors, to the RBI, are in addition to that. Okay, yeah. Therefore, the auditor will have to be very careful. In case of NBFCs, in case of banks, in case of insurance companies, auditor needs to be extremely careful because these are all public interest entities. So any of these things, any of these transactions or any of these events which may lead to a fraud will have to be carefully analyzed by the auditor. So auditor has to be extra careful, I would say, whenever he will be auditing any of these types of entities. So RBI Act, which was under this RBI Act, the auditor of NBFC or this non-banking miscellaneous company which has accepted public deposits has to inquire whether or not company has furnished to RBI statements, information of particulars relating to deposits. Means some of the regulatory requirements which may be imposed on him, whether those have been furnished or not. This is again auditor needs to ensure. The provision further states that if on inquiry the auditor is not satisfied about the compliance by the company, it is his duty to to the Reserve Bank of India, giving the aggregate amount of deposits held by the company. The auditor is also required to incorporate the report or intended to be made to the Reserve Bank of India in his report to the company under section 143 of the Companies Act. So all of these reporting requirements are coming from the RBI Act, which are in addition to Companies Act, which anyways NBFC will have to take care of. So let's look at this report to the Board of Directors as per the RBI directions. RBI has issued NBFC Auditor's Report Reserve Bank Directions to the auditor of every NBFC. So that means there are specific regulations as around the auditors in terms of their reporting requirements. The directions shall apply to every auditor. So there is no threshold to every auditor of NBFC. They will have to follow these directions. That means it's very, very important for us to be aware of that and to be careful that we are following each and every regulation from that in case we are the auditors. Auditors to submit additional report to the Board of Directors in addition to the report made by the auditor under Companies Act or any of the provisions of the Companies Act on the accounts of NBFC which are examined for the financial year ending on any day or after the commencement of these directions. Auditors shall also make a report to the Board of Directors. Report to the Board of Directors on the matters specified in para number 3 and 4. So what are these matters? First, material to be included in auditor's report to the Board of Directors. In case of all NBFCs conducting non-banking financial activity without a valid certificate of registration granted by the RBI is an offense. Therefore, if the company is engaged in the business of NBFC and meeting the principal business criteria, remember 50% of the total income becomes financial income, 50% of the total assets become financial assets. Auditor in such a case should examine whether the company has obtained certificate of registration or not. In case of a company holding certificate of registration, where the company is entitled to continue to hold such certificate as on March 31st of the applicable year. Means whether this validity of certificate of registration will continue. Maybe this may not be held. Why? Because the entity, that NBFC may not be meeting the net own fund requirement. Remember, net own fund requirement is also there. Whether the NBFC is meeting the required net own fund requirement. These are the things which the auditor will have to check. Okay. A certificate from the statutory auditor is required to be obtained. For what? That it is engaged in the business of NBFC, requiring it to hold a certificate of registration and it is eligible to hold it. So auditor will provide this certificate, and the auditor's certificate in this regard with reference to the position of the company as at the particular reporting date. So let's say, for example, 31st March 20 may be submitted to the regional office of the Department of Non-Banking Supervision within 1 month. The certificate may be submitted to this within 1 month from the date of finalization of balance sheet, in any case not later than December 30th. So in case, let's suppose the reporting year is 31st March 20. Reporting year is 31st March 20. And let's suppose the financial statements are finalized on 31st of July. So So this certificate should go to this regional office within 1 month. That means by 31st of August. Even if it's delayed, it cannot go beyond 31st of December 2020. Okay, yeah. So that's the upper limit for this reporting requirement. The format of this auditor certificate has been issued. So this format is also prescribed. It's given by the directions. So the directions specify what will be the format of the auditor's certificate in this regard. Yeah. So if you now remember, we were discussing about reporting to the board of directors by the auditor. And we discussed about first point, that was about material to be included in the auditor's report. Okay, material to be included in the auditor's report, wherein we discussed about that one point which is applicable to all NBFCs. So 3A, which was applicable to all NBFCs. Now we are continuing with this point number 3. That means material to be included in auditor's report to the board of directors. Now we are limited to those NBFCs which are accepting or holding public deposits. So now comes the point around those NBFCs. Apart from the matters which are listed in point number A above, means about the certificate of registration, checking about principal business checking, and then issuing the certificate to the NBFC that yes, it is holding that certificate of registration, and yes, it is eligible to hold that certificate of registration. Apart from that, auditor shall include a statement on the following matters. Auditor shall include a statement on the following matters. So what are the matters? Whether the public deposits accepted by the company together with other borrowings indicated below, like from public by issue of unsecured non-convertible debentures bonds from its shareholders, if it's a public limited company, and which are excluded from the definition of public deposit in the non-banking financial companies acceptance of public deposit directions, are within the limits admissible to the company as per the provisions of these directions. Second, whether the public deposits held by the company in excess of quantum of such deposits permissible to it as per the provisions of these directions are regularized. So in this case, we are saying those are within the limits. So first, we are saying those are within the limits. Second, we are saying those are not within the limits. Those are exceeding the quantum, but those have been regularized. Third, where the NBFC is accepting public deposit without minimum investment grade credit rating from an approved credit rating agency as per the provisions of these directions, whether the NBFC is accepting those public deposits or not. Fourth, whether the capital adequacy ratio as disclosed in the return submitted to the bank, means to the RBI, has been correctly determined, means it's about audit of capital adequacy ratio, and whether such ratio is in compliance with minimum capital adequacy ratio. Whether such ratio is in compliance with the minimum ratio which has been prescribed to be maintained by the NBFC. Okay. In respect of NBFCs which are referred to in third above. What is this third above? This one. Means where third above means the one wherein the NBFC is accepting the public deposits. Whether the credit rating for each of the fixed deposit schemes that has been assigned by the credit rating agencies is in force, and whether the aggregate amount of deposits outstanding at any point during the year has exceeded the limit specified by such credit rating agency. Next, whether the company has violated any restriction on acceptance of public deposit as provided in these directions related to acceptance of public deposits. Means again, it's about checking of compliances around all of these points. Next, whether the company has defaulted in paying to its depositors, either the interest or the principal. Whether the company has complied with the prudential norms. This is again required to be reported by the auditor. Compliance with prudential norms. Company has defaulted or not to its depositors. Prudential norms will cover income recognition, accounting standards, asset classification, provision for bad doubtful debts, various other points. Whether the company has complied with liquid assets requirement which are prescribed as per the RBI Act, and whether the details of the designated bank in which the approved securities are held is communicated to the office concerned to the RBI. Whether the company has furnished to the RBI within the specified period return on deposits. Return on deposits, which is specified in NBS 1. 2. Non-banking financial company returns, reserves, the Reserve Bank directions. So you can see there's so many directions, and all of these directions are what? Regulations. You can in simple terms say those are the legal requirements. In simple terms, if one has to understand about that. Okay. And all of these things are required to be ensured by whom? Auditor. What will he ensure? That the compliances around all of these things has been done by the NBFC or not. So you can see so many reporting responsibilities are there on the part of the auditor, and so many additional procedures are required to be performed by the auditor in case of an NBFC. Next, whether the NBFC has furnished to the RBI the quarterly return on prudential norms, which are again specified. Quarterly returns, which quarterly returns? Which are specified in again a different set of directions. Whether in case of opening of new branches of an NBFC, opening of new office of an NBFC, to collect deposits, or in the case of closure of existing branches or offices, or in the case of appointment of agent, the company has complied with requirements of acceptance of public deposit directions. So now this is in respect of opening of branches, offices, to collect deposits. Or if there is any closure of branches, closure of offices, or if there is any appointment of agent. There again, certain compliances are required to be done. By whom? By the management, by the NBFC. And auditor needs to ensure those compliances have been done, because auditor will have to report around these points. So till the time auditor will not audit that, he will not be able to get to know. Okay. Next, in case of an NBFC, now we are talking about point number C. So if you remember, this was B, and now we are moving on to C. In case of NBFC which is not accepting public deposits, apart from the aspects listed in A above. So A, if you remember, 3A applied to all the NBFCs. 3B applied to those NBFCs which were accepting the deposits. Now 3C will apply to NBFCs which are not accepting public deposits. So that means NBFCs which will be covered under 3C will be covering the aspects of 3A as well. We can say this, we can say requirements under point number 3. Because so many points have been discussed, it may lead to a confusion as to which one will get covered under which type of NBFC. We discussed that A will apply to all NBFCs. Correct? B, NBFCs, B covers NBFCs which are taking public deposits, which are accepting public deposits. So B was for those NBFCs. Now coming to C. Coming to C. NBFCs which are not accepting public deposits. Okay, so that is how we have bifurcated all of these points. So what are we saying? We are saying that requirements of point A will apply to these two NBFCs also, because it covers all. So whenever we'll look at the requirements, we'll say A plus B, or we'll say A plus C. Clear? Yeah? So now what's the point? In case of NBFC which is not accepting public deposits, in addition to points covered under A above, auditor shall include a statement on the following matters. Let's see, what are the matters? Whether the board of directors has passed a resolution for non-acceptance of any public deposits. So, resolution of the board for non-acceptance of any public deposits. There should be such resolution, to which there is a clarity internally that the public deposits will not be accepted. Whether the company has accepted any public deposits, so even though they were not accepting, but the company accepted any public deposits, if any. Yeah. Third, whether the company has complied with the prudential norms. So these will come over here also. What are the prudential norms? Prudential norms are about income recognition, accounting standards, accounting asset classification, and all of these things. So those will come over here also. In respect of systemically important non-deposit taking NBFCs, systemically important non-deposit taking NBFCs which are defined under their regulations. Which regulations? There are specified regulations for that. Now what's the requirement? Whether the capital adequacy ratio as disclosed in the return submitted to the RBI has been correctly arrived at. It's the same point. You may be thinking that it was there in point number B also. No problem. So these NBFCs will also be required to ensure this, and the auditor will also be required to check this. And whether the company has furnished to the RBI annual statement. Whether the company furnished annual statement of capital funds, risk assets exposures within the specified period. This is the second thing. Yeah. Next, whether the NBFC has been correctly classified as NBFC microfinance institution as defined under NBFC non-systemically important non-deposit taking directions. So under these directions, NBFC microfinance institution has been defined. So any of the NBFC which will fall within that definition has to classify itself as NBFC microfinance institution. So that classification, whether the NBFC has done for itself or not, and the auditor needs to check that. D is for the NBFCs wherein the business of wherein the entity is engaged, wherein the company is engaged in the business of NBFC, or they say non-banking financial institution, which are not required to hold certificate of registration subject to certain conditions. So let's suppose if there are certain conditions apart from the matters enumerated in A above, we are saying there is another category which are not required to hold certificate of registration. Now for these NBFCs also requirements of A will apply in a limited manner, except for this certificate of registration, because they are not required to hold certificate of registration. So apart from the matters enumerated in A first above, where a company has obtained specific advice from the RBI that it is not required to hold certificate of registration, auditor shall include a statement that the company is complying with the conditions which are stipulated as advised by the RBI. So this is again a statement which will be given by the auditor. Okay, yeah, all of you clear on this? Just give me 1 minute. So we have discussed about the requirement which were covered under point number 3 above. Now we will move on to point number 4, and you need to go back to this requirement of point number 3 and 4. Remember point number 3? So let's go back. What was this point number 3 or 4? What was this point number 3 and 4? Point number 3 was in respect of report to the board of directors, wherein we discussed that auditor shall make a separate report to the board of directors on the matters which are specified in point number 3 and point number 4. So under 3 we discussed what all reporting requirements auditor will have depending on the types of NBFCs. Correct? Depending on the types of NBFCs. Now we'll look at the requirement of point number 4, which will be considered by the auditor for reporting to the board of directors. Okay. So you should be clear on this aspect as to which all points we have been discussing, and these are in relevance to which type of reporting, because you must have got lost by now and you must be thinking, sir, how many reporting requirements are there? So it's multiple. That's why you need to be very, very careful in terms of just understanding all of these points. Reasons to be stated for unfavorable or qualified statements. What are these unfavorable or qualified statements? It's similar to what we call as qualified report or modified report, which the auditor will give, where in the auditor's report the statement regarding any of the items which are covered in para number 3 above, where in the auditor's report statement regarding any of these points A, B, C or D. So around any of these points, let's suppose statement of the auditor is unqualified, is unfavorable or qualified. So that means let's suppose this is qualified, or say this is qualified, this is qualified, or say this is qualified, or unfavorable. The auditor's report shall also state, so that means auditor's report has stated that these are qualified, correct? Now it says that the auditor's report shall also state reasons for such unqualified statement. Sorry, unfavorable statement, unfavorable or qualified statement. Where the auditor is unable to express any opinion on any of the items covered under 3A, B, C or D, his report shall also indicate such fact together with the reasons therefore. So let's suppose auditor says that he is unable to express any opinion. The first situation is qualified or unfavorable. Second situation is not able to express an opinion. Yeah, not able to express an opinion. In both the cases, reasons are required to be given by the auditor in those statements. Means he should not just simply say this is qualified, this is unfavorable, I am not able to express my opinion. He should also justify that. He should give a reasoning for that, which is logical, correct? And which is something you'll also see in respect of the auditor's report on the companies, wherein the basis of opinion is given, correct? Yeah. Next, moving on to the obligations of the auditor to submit an exception report to the RBI. Now this is in continuation to the reporting requirements. Let me just go back to the reporting requirements that we discussed. Auditor was required to report to the board of directors. Let me just go back to that point that we discussed, because you can also summarize all of these points. Let me just quickly summarize for you. So what are the reportings on the part of the auditor? So the reporting on the part of the auditor, because this will help you to understand all the reporting requirements. First, that is as per section 143 of Companies Act. Yeah, something which we have seen multiple times. Number 2, reporting to the board of directors, for which point number 3 and point number 4 are required to be considered. So we can say how many reportings do we have as an auditor of NBFC? This is first, this is second, then there is another reporting to the RBI on an exception basis. So this one we all know, we all understand in complete detail as to what is this reporting. This one is something that we have just discussed, point number 3, and this is point number 4. So you can also mark this. This is point number 4. Point number 4 captures two things, 1 and 2, or maybe you can just say this is A, and this is small b. All right. For your ease. Third comes the reporting to the RBI on an exception basis. Yeah. So let's now get on to this third type of reporting requirement on the part of the auditor of the NBFC. Next one. Where in the case of NBFC, statement regarding any of the items referred to in para 3 above. Which one is this? 3, covering A, B, C, D. So wherein the statement is unfavorable or qualified, or in the opinion of the auditor, company has not complied with provisions of RBI Act, specified provision of the RBI Act. Which provision is this? Chapter 3B. We are saying 1, it's 3 plus 4. So what's the reporting in the statement? For 3, for any of these statements, there is qualified or unfavorable opinion, or in the opinion of the auditor, provisions of RBI Act have not been complied with, or NBFC's acceptance of public directions have not been complied with, or NBFC non-systemically important non-deposit taking directions or systemically important non-deposit taking company directions have not been complied with. That means either it's the qualified or unfavorable opinion on any of these statements, or non-compliance of any of these provisions. Which provision? This one, this one, this one. And please understand, these are or, these are not and. In such a case, it shall be the obligation of the auditor. It shall be the obligation of the auditor to make a report containing details of unfavorable or qualified statements, or about non-compliance of any of these provisions in respect of the company to the concerned regional office. So auditor will report to the concerned regional office. Yeah. The duty of the auditor under this point number first shall be to report only the contraventions. He will be reporting only the contraventions. And such report shall not contain any statement with respect to compliance of any of those provisions. So the duty, the requirement on the part of the auditor is not to then send a checklist to RBI. No. So auditor will not say there were 100 compliances. I have complied with, the NBFC has complied with 1, 2, 3, 4, 5, 6, 7, 8, 9 have not been complied with. 10 is complied, 11 is complied. No, it says only the known contravention. Only the contraventions are required to be produced in that statement, which will then be reported to the RBI. That means only the exceptions are required to be reported. Okay, all of you clear on this? All of you clear on this? Any questions, any doubts from your side on this? So now we can look at certain questions based on whatever we have discussed so far. Yeah, we can discuss certain questions based on whatever we have discussed so far. And I can also see some of your queries which have not been answered for some time. So let me just go to your queries also. Shubham is saying it's not an exhaustive list, it's inclusive list. Yes, that's correct. I think you were talking in the context of wherein I mentioned all the frauds are covered. That's true. So just saying that if you look at this, everything seems to be getting covered. Huh? That was the point. Then Hiba is asking, sir, have we covered internal management operational audit? Yes. In the morning we covered that. Ambika is then asking, sir, can you give brief about role of systemically important in case of NBFC? And is it systemically important NBFC comes under tighter RBI scrutiny? So basically, she wants to obtain an understanding about some of these regulations which are applicable to these type of NBFCs. See, when you look at all of these regulations, what these regulations have tried to do is, they have tried to first of all segregate the NBFCs into various categories. And they have assigned name to them. Some of these names are systemically important or non-systemically important. Then non-systemically important is respect of NBFCs which are taking the deposits or non-taking the deposits. Okay. Now, as regards your query that, sir, will they be subject to some tighter regulations? I won't say that there are any tight regulations for only the systemically important. I would say even for non-systemically important, regulations are very tight. And you can clearly see so many regulations are there. See, if you look at any bank or any NBFC today, they have a separate department for compliances, for legal requirements, without which they cannot survive because the regulations are so many. So if they want to go ahead and run their operations and they do any sort of non-compliance and wherein the RBI is involved, then it is in any case considered to be a very stringent requirement. Yeah, so I would not really dilute the requirements of non-systemically important by calling systemically important directions to be tighter than the other one. It's just that some of the requirements are different. And in case you really want to get into the details, so I would advise you can just go through these directions. Some of these directions are specified in the module also. And in any case, you can just capture these directions and you can just download these directions and just flip through them. So they are, I think, running into some 50 to 60 pages. But you can just flip through both of these directions and you will be able to understand the differences. Okay. So now let me just move on to the next question around the NBFC. So we can just try to look at the reporting requirements. So let's say there is an NBFC and for which certain irregularities etc. have been reported and in respect of which the reporting requirements to board of directors have been triggered. Okay, so the reporting requirements which we just saw in case of point number 3. Let me just look at this point number 3 and let me just see as to any of the points which may get captured over there. So I'm talking about 3A now. And then we can move on to point number 3B. Now it's an NBFC which is accepting Public deposits. It's an NBFC which is accepting public deposits. And for this NBFC, CRAR is not as per the prescribed norms. Okay. Third, now in this case, even though CRAR is not as per the prescribed norms, this difference is marginal. So I'm not getting onto the number as to what is the CRAR which is required to be maintained. We are not required to get into that. We are just looking at the difference. So that is not as per the prescribed norm, and when you look at the prescribed norm, this is marginal difference only. Now in this case, the auditor of this NBFC is considering of reporting this matter. Okay, auditor of this NBFC is considering of reporting this matter. Reporting of the matter that the CRAR is not as per the prescribed limit or the specified limit of the required regulation. So what will be the reporting requirements on the part of the auditor? So one, in this case, auditor will require to report to the board of directors, and he will give unfavorable statement. B, auditor will report to the board of directors and he will give, or I can say he will not give a favorable statement. Sorry, not give an unfavorable statement. Number C, auditor will report to board of directors, give unfavorable statement, plus auditor will also report to RBI and will give the contravention and will report the contravention. Okay, and I think fourth option also needs to be added. So let me just try to think through this fourth option. It's simple one. You may be thinking, sir, it's very simple. Yeah. So all of these things are simple. Option number D. Auditor will report to board of directors, give unfavorable statement, plus will report to RBI and will give non-compliances plus other compliances. List of other compliances. Non-compliances you can say is the contravention, or I can also change this language, that is contravention. Okay, and in this case we can say only one reporting is required. So you can add the word only, and in this case also you can say reporting to only board of directors is required. So option number A and B are saying reporting will be done only to the board of directors. C and D are saying reporting will be done to two parties, board of directors and RBI, board of directors and RBI. So that's the option, or that's the options that we have. Now we need to just think through about all of these options and check as to which option will fit over here. Yeah, so we can just look at the options now and try to analyze which of the options will be considered to be the best one. Okay, yeah. So first one, there is a non-contravention, no doubt about it, and which is contravening the requirement of the regulation. CRAR should be as per the prescribed limit. If that is not as per the prescribed limit, auditor will need to report that. So auditor will definitely report. So this point seems to be correct. The moment we say auditor will need to report and that will be unfavorable, so option number B automatically goes away because these are mutually exclusive. Yeah. So in this case, it is easier for us to find the right option. So option number A seems to be perfect right now. But we also need to go through option numbers C and D. As of now, option number A seems to be the correct answer. Now let's look at option number C. Option number C is also capturing option number A within itself. But it says along with the reporting to board, the reporting will also be done to the RBI, and that will be for this contravention. So do we think that the reporting to RBI is required? So I think it's there on your screen. So it says the statement regarding any of the items captured to in para number 3B above. So this was an item which got captured under para number 3B. Sorry, para number 3. And let's suppose if that was unfavorable or qualified, then the reporting to RBI is required. That means option number C is also correct. And the moment we say option number C is correct, A doesn't seem to be all right now, because A is not requiring the auditor to report to RBI. So that means this is partially correct. This is not completely correct. Which is the completely correct option? Option number C. Yeah. But we also need to check whether option number C is also partially correct or completely correct. So let's go to option number D. Option number D says yes, board of directors reporting, RBI reporting of the contravention. Along with this, it says auditor should also give a list of other compliances to RBI. So let's read this para that we have just discussed. The duty of the auditor shall be to report only the contravention, and such report shall not contain any statement. You remember we highlighted on this point. Any statement with respect to compliance of any of these provisions. So if the auditor will give list of other compliances, what will happen? He will not be reporting to RBI on an exception basis. So what is it that the RBI is looking at? RBI is not looking for the complete details. They are saying that please report us only the exceptions. So it's the exception report which will go to RBI. That's it. So that's why option number D is not correct, because it includes an option, or it includes a requirement which is not required to be done. So what will be the right option over here? Option number C. Okay. Yeah. All of you clear on this? Clear on this reporting requirement now? We can then move further. Compliance with CARO. I think this is something which you have covered in detail already, but still we can just go through the requirements of CARO in respect of those clauses which are specifically in respect of NBFCs. Under CARO, there is a clause which says whether the company is required to be registered under RBI Act, and if so, whether the registration has been obtained. And you may be thinking, sir, is it not a duplication? Why? Because we have just discussed. Let's go back. Where was this registration requirement discussed? 3A, which applied to all the NBFCs, means auditor of all the NBFCs will be required to report to the board of directors in respect of registration requirement of NBFC. So auditor is already reporting this point to the board of directors in a statement. And in case of an exception on that, auditor is also reporting that matter to the RBI. Now, along with this, the audit report, which is required as per the Companies Act, that means CARO, that is also requiring the auditor to comment on this point specifically. So that means registration is considered to be of extreme significance in case of an NBFC. The auditor is required to examine whether company is engaged in the business which will attract the requirements of this registration. The registration is required where the financing activity is the principal business. RBI restricts companies from carrying on the business of NBFC without obtaining certificate of registration. And an NBFC is a company registered under the RBI Act, engaged in the business of loans, advances, acquisition of shares, or various other things. Yeah. What is a financial activity? We all understand what is a financial activity. Okay. Now, in this context, what is it that the auditor will be required to audit? First of all, he will be required to check whether this entity or the institution is having financial income from the financial assets. So that means what is their principal business? How will he get to know about the principal business? He will look at the books of accounts. He will look at the contracts. He will look at the arrangements. He will also go through the minutes of this institution or this company. He will also have discussions, inquiries with the management. He will also have the review or the scrutiny of the transactions. He will also do the analysis of the financial statements in terms of the balance sheet, in terms of the P&L, whether they are having the ratios of financial assets and the financial income in excess of 50%, or which is making them greater than 50% as regards the total assets or the gross income. All of these procedures will be required to be performed by the auditor. And if you'll see, all of these procedures would have already been performed by the auditor, even if no such requirement would have existed under CARO. Even if no such requirement would have existed for reporting the auditor to the board. Why? Because for any entity, when the audit will be carried out, registration is something which the auditor will definitely check. Because an entity, for an entity to run the business, for an entity to operate, registration requirements are mandatory. So if the entity will not have all of these registrations, etc., what will happen? There will be legal problems around it. That's why all of these things anyways become important on the part of the auditor. Okay. Next procedure is around this clause of CARO, which says whether the Nidhi company, you remember Nidhi company, it was also a category of NBFC, has complied with the net earned funds to deposits in the ratio of 1:20. Means against their deposits, their net earned funds should be 1:20. Why? To meet out the liability. And whether the Nidhi company is maintaining 10% unencumbered term deposits to meet out the liability. Okay, so this is the second requirement which they need to have. Now this clause requires, first of all, an auditor to evaluate as part of his audit procedures whether the company is Nidhi company or not. And how will he get to know about it? Through the registration documents. And then he will get on to the computations of net earned funds. Then he will review the liabilities of the company. Then he will review the deposits of the company. Then he will also check about their classification, whether all the deposits which should have been reported or classified as deposits are appearing under deposits head or they have been included under some other head, because accordingly these ratios may get disturbed. Yes or no? Similarly, around the term deposits which they may be maintaining, he will check whether those are unencumbered or not, and what is their percentage as around the total liability. Now all of these workings will be made available to the auditor through the management itself. So the management will provide all of these details to the auditor. It's the duty of the management to provide all of these details to the auditor. Auditor is only required to verify the supporting documents. Okay? Yeah. And in case any of these things are not found in order, then what will the auditor do? Auditor will have to just report about that matter in this clause under CARO. Okay? Yeah. Now moving on to the next part, and that is about applicability of the accounting standards. Now, on the accounting standards, we can see that currently there are two sets of accounting standards. One which is about old set of accounting standards, which is called as AS or the accounting standards. Commonly, Indian GAAP is known by those accounting standards. Then we have another set of accounting standards which are fairly old now, which are called as Ind AS, and which are commonly referred to as, this replica of IFRS. Now, certain NBFCs, depending on certain criteria which are prescribed, were required to follow Ind AS. So let's see what's the criteria in respect of applicability of Ind AS to those NBFCs. Now this applicability of Ind AS to the NBFC, first of all, arises on the basis of its net worth, and then it arises on the basis of whether the NBFC is listed or not on any stock exchange, and third, it arises on the basis of the group companies. So we'll talk about all three of them now. In case an NBFC will have net worth of 500 crore or more, so in such a case, irrespective of whether it is listed or unlisted, in case an NBFC will have net worth of 500 crore or more, then irrespective of whether it is listed or unlisted, Ind AS will become applicable to that NBFC, and all those NBFCs were required now, because this period is gone. All those NBFCs were required to follow Ind AS from the reporting year 2018-19. wherein they would have also considered applied Ind AS on their comparative year while preparing the financial statements of 1819. So this is already gone. So we can see all of those NBFCs are on Ind AS now. And in this case, there was no listing criteria, etc. Second, any NBFC which got covered under Ind AS in the financial year 1819, so we can say this was phase 1 of NBFC. For our ease, phase 1 of NBFC. For such type of NBFCs, if they had any holding, subsidiary, associate or JV, all of those companies were also required to follow Ind AS from financial year 1819. They were also required to follow Ind AS from 1819, irrespective of the net worth. Because this net worth criteria is only about one NBFC and any of their group companies. On the basis of this criteria of holding, associate, JV, subsidiary will make the group companies getting covered under the Ind AS. Okay. Then comes the second criteria or the second phase or the second categories of NBFCs on which Ind AS became applicable from next financial year, means financial year 1920. Now in this case, NBFCs having net worth of 500 crore or more are already covered. They are already covered. So now the NBFCs which have net worth less than 500 crore but 250 crore or more are covered. So NBFCs having net worth of 250 crore or more but which are not covered in phase 1, which are not covered in 1819, they got covered in 1920. Similar to phase 1, any holding, subsidiary, JV, associate of these NBFCs which got covered in phase 2 were also covered in phase 2. Third, there was a listing criteria which said that if there is any listed NBFC and irrespective of its net worth, if that listed NBFC did not get covered in phase 1, then it will automatically get covered in phase 2, irrespective of the net worth. So NBFC, if that is listed, will automatically get covered in phase number 2. And therein, for that listed NBFC, net worth etc. will not be required to be checked. So that's the criteria which was followed for the applicability of Ind AS. So you can say that currently all of these NBFCs are on Ind AS, depending on their net worth criteria, depending on their listing criteria. But the NBFCs which will have net worth of net worth less than 250 crore, they are not on Ind AS. Okay, yeah. And then we have a separate format of financial statements given as per the Schedule 3, Division number 3. So Schedule 3, Division number 3 prescribes the format of preparation of financial statements, which you can go through. Yeah, so this format is available. You can just go through this format quickly. So what we can do is we can now take a break of 10 minutes. After the break, we'll continue our discussion on this NBFC. So we are still left with some part of NBFC. And once we are through with that, we'll start a new chapter. Okay. And in the meantime, if you are not really going for a break, we'll just flip through some of these requirements that we have discussed. All right. Yeah. Hi, welcome back. So we were talking about NBFCs and the provisions around NBFCs, the requirements in relation to NBFCs which the auditor needs to consider. And the last thing that we discussed was about the Ind AS, which is more of about the financial statements of an NBFC. So now if you look at the format of the Ind AS, so we'll not get into too much details around this format. So you can say it starts with financial assets. And you must be knowing the importance of the financial assets for an NBFC. Yeah. So it includes receivables, loans, investments, other financial assets, cash, bank balances, derivative financial instruments, and the non-financial assets, which is all about PPE, investment property, current tax assets, biological assets, if they will have any, goodwill, intangible assets, etc. Then it will talk about the liabilities, trade payables, which is again broken into financial and non-financial, the way Ind AS requires. And if you look at the P&L of the NBFC, it will largely be comprising of the financial income, which is in the form of interest income. So now what we can do is we can now go to the procedures in relation to audit of an NBFC. And for which, if you remember, there was a checklist which we skipped, which talked about the audit procedures specific to an NBFC. And I'll not really go through this checklist. This is something for your reference only. I'll go through some of the other procedures which one can anyways think in the context of an NBFC. So let's suppose if we are the auditor of any NBFC and we are required to perform certain procedures, and let's suppose if you have a question to answer or maybe to prepare a checklist in relation to the audit of an NBFC. So let's think about the audit procedures which may be required to be performed. The first audit procedure will start with the understanding of the business. So we can say first is about the understanding of the business. Second will be about the understanding of the processes, etc. Number two will be about the risk assessment. Like for any other company, NBFC will also be exposed to various risks. Their processes will also be exposed to various risks. So this risk assessment will also be required in case of NBFC. NBFC will also have certain controls. So the audit of internal control systems. Audit of internal control systems in relation to an NBFC will also be required. Number four, once we are through with all of these things, what do we say? We are largely done with the planning part. And that is what we have discussed so far in our previous sessions, that the planning part will cover majorly some of these requirements. And you may be thinking, sir, are these same what we would have covered in case of any other company? The answer is yes. And all of these procedures will apply to any entity. So what I'm trying to say here is that whether it's an NBFC, whether it's a company, so irrespective of the nature of the business of the entity, the basic audit approach will always remain same. So we will not say that just because an entity is an insurance company, just because an entity is a banking company, just because an entity is into manufacturing, just because an entity says into trading, the audit approach will change. No. Definitely certain specified audit procedures may have to be tailored. But if you look at the basic audit approach, which comprised of four things, what were those four things? Planning, execution, conclusion and reporting, they will always remain same for any type of entity. So that means for NBFC also, all of these 4 points will be applicable. And in relation to all of these understanding, etc., when the auditor will be going through the business, going through the processes, he would also want to verify all of these things by looking at the supporting documents. So he can verify the requirements related to certificate of registration. He can verify the requirements related to the principal business. In fact, that can be verified over here only. That can be understood and verified over here only. He can look at the workings of the management. Then comes the point around classification of an NBFC. You remember NBFCs can be classified into various categories. Now, whether the NBFC has categorized itself into the right category or not, because on the basis of the classification, the directions will change. The applicable regulations will change. So that's why it's very, very important to have the right classification for the NBFC. Otherwise, there could be a non-compliance of various provisions. Yes or no? And with this, we can say it's also about checking of compliances, which is going to be a big thing for any auditor of NBFC. Compliances of various regulations. Compliances of various regulations which will be applicable to an NBFC. Yeah, so all of these things will become important for an NBFC. Now, other than this, there was a point which we discussed in the context of execution and testing. In the case of substantive testing, what will the auditor cover? Auditor will cover test of details. Auditor will cover analytical procedures. Auditor will also cover substantive analytical procedures. So all of these things will be required to be performed. And in relation to an NBFC, what will he focus on? He will focus on some of the critical items of the financial statements. And for an NBFC, what will be the most critical item on its balance sheet? Advances. Loans and advances will be the most critical item on its balance sheet. So various procedures will have to be structured around the audit of loans and advances. And for the loans and advances, there will be again certain policies and procedures. There will be certain processes, certain regulations, which the NBFC would have been would be required to comply with, which it would have complied with. And in case there were any non-compliances of those provisions, or in case some of the policies and procedures in relation to loans advances were not followed by the NBFC, then the auditor will be required to understand the implications of those. Around the loans advances, another point which becomes important is in relation to its classification. So now we also have the classification of loans advances into various categories: standard, substandard, doubtful, or loss assets. Means what? Classification into NPAs or PAs. Now, all of these workings would have been done by the management, but all of these workings would have to be reviewed by the auditor with reference to the applicable regulations. Because for NPAs, again, there's a detailed list of regulations as to which asset will become NPA, and then there are various prudential norms which get triggered because of this around the income recognition. Classification is something we have already discussed. Yeah. And along with this, another point which gets triggered will be around the provisioning requirements. Provisioning requirements, whether the provisions have been made adequately or not. Is it that any of the advances, is it that there are certain advances on which NPA classification is not done? Means the advances should have been classified as NPA, but those have not been classified as NPA, and because of which provisioning is on the lower side, and because of which income recognition is on the higher side. So there are so many implications which may arise just because of any non-compliance which the NBFC may do. Correct? Yeah. Similarly, we can think about so many procedures regarding various other items of the balance sheet of this NBFC. I'm not getting into those components in detail because we are already familiar with that. Another very important component on the P&L side will be what? Financial income. So we can talk briefly about financial income also. So now I'm moving on to the P&L. I'm talking about financial income. Now in relation to financial income, most of the procedures would be linked to the procedures that the auditor will apply over here. Because the income recognition will be on these loans and advances. So the checking, the tests, the recomputations which the auditor will do on these types of workings or on these balances or on these transactions will also be resulting in the conclusions around the financial income. Okay. Yeah. Around the financial income, we also know that there are certain prudential norms. So on that point, auditor has to be very, very careful because there should not be overbooking of income. Correct? Yeah. Now with this, we can also think of so many procedures around other line items in the P&L of the NBFC, because NBFC will also have people. So NBFC will also have payroll. NBFC will also have various administrative expenses. NBFC will also have certain items of PP on which depreciation would have been charged. So like any other entity, so many items in the financial statements of the NBFC will exist, which would be common to what we see in case of a company. So if we are required to think through the procedures in respect of audit for all of those financial statement line items, most of them will be similar, except for certain specific items which are mostly around the compliances. Because in the case of an NBFC, what is going to be the different item? Compliances. And last but not the least will be about the conclusions and reporting, which we have already discussed in detail. And what are the reporting requirements? Companies Act. Reporting to Board of Directors. In addition to that, reporting to RBI on an exception basis. Okay. And other than that, we also discussed that if there is any fraud which may be detected, which may be suspected, yeah, which may have been proved, so the auditor will also be required to report all of those matters or furnish the details in respect of all of those types of events to various authorities which have again been discussed. Okay, yeah. So if you have to think about audit procedures, I think this will become a very, very simple question for you now, because if you have to put down audit procedures, you can just see there's n number of audit procedures. We have just limited ourselves to only some critical types of audit procedures. That's it. Yeah. Clear on this? Any questions from your side on this? Because with this, we are done on NBFC. Okay, so we are through with NBFC, and the next topic that we plan to do will be insurance, around the insurance company. Okay, so now we move on to our next chapter, that is about audit of insurance companies. I would say insurance company, though it happens to be a completely different type of company in terms of the nature of its business, but this is also highly regulated. This is also subject to various laws and regulations, because here again public interest is involved and significant public interest is involved. So that's why these are also highly regulated in a similar way like NBFCs are regulated, though the regulatory authorities happen to be different over here. So it's not RBI which will be a regulatory authority over here. It's going to be a different authority. Yeah. So let's understand about the insurance. Though we all know about insurance, but still let's try to have some brief understanding about the insurance, and then we'll get into the further details around the audit procedures around all of these insurance companies. So what is insurance? In simple terms, we can say that if there are two parties, and one party, let's suppose, is at some risk. Say for example, I am at risk and I have a risk of losing my life, which can happen at any point of time, which is not in my control. Now this happening of this event, which is not in my control, is a risk to me. So what can I do? I can reach out to an insurance company. Let's suppose I go to an insurance company and I tell them that I have this problem, I have this risk. So what can they do? They can say no problem. So now from now onwards, you should stop worrying about this. You need not worry about this at all, because we will take up this risk of yours completely. So that doesn't mean that they will be able to save my life. No, that means my risk was that if I lose my life, then there could be certain financial problems which may be faced by the persons who are dependent on me. So what the insurance company may do, they may say, okay, fine. So we will make sure that all of those financial problems are taken care of, because in case of happening of this event, a fund or an amount will be paid to the persons. Okay. Similarly, it may be in relation to some of my assets. Say for example, car. We get this car insured. And why is this car required to be insured? Not only because this is again a regulatory requirement, but also because if there is any loss to this car due to any reason, maybe there's an accident or so, any reason there's a loss to the car, then that will be compensated by the insurance company, for which insurance company will also charge something, and that charge which the insurance company will take is called as insurance premium. Against the insurance company on the happening of this event, what can I do? Let's suppose if there is an accident, what can I do? I can raise a claim to the insurance company. Once the claim will be approved, so they will make the payment to me in respect of the loss which I would have suffered in respect of the car. So this is how this insurance business runs. So let's take the example of, let's take the difference between this life insurance and general insurance. So two examples we have discussed. So what is this life insurance? Life insurance may have a term which may be fixed or variable, but For in general insurance means insurance for other than life. Therein, the term is always fixed. It is always for 1 year, and then it is required to be renewed every year. For life insurance, payouts are certain, either as claims or maturity benefits. Payouts are certain. In case of general insurance, payouts are not certain. So if we pay the premium to the insurance company for the insurance of the car, so does it mean that at the end of 1 year, insurance company will pay some claim to me? No. So they will pay the claim amount only if there is a loss to the car. Otherwise not. So that's why in a general insurance, payouts are uncertain as claims may or may not arise. Okay. In case of life insurance, it could be multi-purpose. It could be involving investment benefits. It could be involving tax benefits, or it could be a pure insurance. But for a general insurance, you will not see that. General insurance will only be covering the insurance component. It will not be covering the investment component. You must have seen various policies wherein you would have received a call that this is the policy which you can buy, this is the policy which you can buy, wherein the investment benefits are also involved. But all of those investment benefits you will always see in the case of life insurance and not in the case of general insurance. So let's see some of the regulations which may be considered to be applicable to some of these insurance companies. One is the Insurance Act, which is amended by Insurance Laws Amendment Act. Second is Insurance Regulatory and Development Authority Act, as amended by Insurance Laws Amendment Act. Next, Insurance Regulatory and Development Authority Regulations. Next, Companies Act, because it's a company, so that regulation will continue. IRDA investment regulations. Yeah, so you can again see so many regulations are required to be considered, not by all the insurance companies, depending on which all regulation will become relevant to which all insurance company. Okay. So now registration of this Indian insurance companies. This Insurance Act requires every insurer to obtain certificate of registration, similar to what we saw in case of NBFC, before commencement of insurance business. Okay, yeah. The requirements as to the minimum paid up capital, therein we were calling it as net owned fund. What was net owned fund? Capital only. Now we are using the term capital. So the minimum paid up equity share capital of Indian insurance company carrying on insurance business should be 100 crore. Means any company which is having below 100 crore cannot get into insurance business. And this 100 crore is excluding preliminary expenses incurred in the formulation and registration of this insurance company. Yeah. Now all of these things we have discussed. Let's quickly talk about the form and the content of the financial statements. Insurance company will be required to prepare balance sheet, profit and loss account. These two things are same, what we see in case of any other company. They are also required to prepare a separate account of receipts and payments. The separate account which they prepare. Then they are also required to prepare another account, the revenue account, for each year. So this will comprise of their financial statements. Okay, yeah. And for the life insurance business, Schedule A is something which will become applicable in relation to the financial statements. For general insurance business, Schedule B will become applicable. For Schedule C to the regulation lays down the matters to be dealt within by the auditor's report of an insurance company. So this is something which becomes more important for us other than A and B. Schedule C is applicable to insurers carrying on general insurance business as well as life insurance business. So that means all of these considerations around the auditor's report will be common to both. Okay. Now let's move on to the audit of accounts. Financial statements of every insurer are required to be audited annually. So audit for an insurance company is a must. Every insurer required to be audited annually. And who can be the auditor? Chartered accountant can be the auditor. Okay, chartered accountant can be the auditor of a company. Now let's quickly talk about the appointment of the auditors. Appointment of statutory auditors in the General Insurance Corporation of India and its subsidiaries and divisions is made by CAG. CAG is Comptroller and Auditor General of India. As in the case of other public sector undertakings, which we'll discuss. For example, if you look at some of the entities like New India Assurance Company Limited, United India Insurance Company Limited, they are into general insurance. However, in case of others means other than this general insurance one which we have just discussed, auditor will be appointed at the annual general meeting after ensuring that the auditors satisfy the compliance requirements as per the IRDAI guidelines on corporate governance. These guidelines pose certain restrictions on the number of insurance companies a statutory auditor can audit. So now there is a cap in respect of audit of insurance companies by an auditor. So what is the cap? An auditor can conduct only for audit for 3 insurance companies and not more than 2 life or 2 general. The total should be 3, out of which life insurance companies can be 2, general insurance companies can be 2. So how will it become 3? 2 life, 1 general, 2 general, 1 life. And other than this, it's mandatory to have a joint audit. What is a joint audit? I hope you all know about that. Joint audit will require 2 auditors to audit the financial statements of the insurance company. So it will not be a one auditor. So it will not be, so when we say one auditor, means we are talking about audit firm or proprietor, either of them. And when we talk about joint auditor, so it can be 2 audit firms, it can be 1 partnership firm, 1 sole proprietor, or say 2 partnership firm. It can be either way. Yeah, 2 auditors will mean any of the audit firm or the sole proprietor who is practicing chartered accountant and who is eligible to act as the auditor. Okay, yeah. Now in respect of insurance companies, there are certain specific points that we need to understand as regard the audit of the branches, which are audited by the branch auditors. So what are the rights and duties of the branch auditors? See, generally what you will get to see is that books of accounts in case of an insurance company will be centralized. Okay. Unlike the traditional models which used to be there, you will see the books of accounts of an insurance company are centralized. And that's why the branches may have limited records, but the complete set of books of accounts are centralized and which can be audited by the auditor sitting at the HO. But still, in case of some of the entities which are more of, in the nature of this public sector, they may be having branches and wherein certain of their components as around the financial reporting could be decentralized, wherein this will become more important for us. It's a practice in certain public sector insurance companies. We are talking about public sector insurance companies, because for private insurance companies, private means which are into private sector. So public sector is one which is around this New India Assurance, United India Assurance. What is going to be the private sector? For example, if you talk about ICICI Prudential, HDFC Ergo, they are all into the private sector. It's a practice in certain public sector insurance companies that the divisional offices prepare a trial balance in the manner that it provides information required to be included in various formats of financial statements. Each trial balance in which are incorporated the figures related to branches of the divisions is required to be audited, and the report thereon is furnished to the statutory auditors. The divisions of the companies carrying on general insurance business are treated for the purposes of Companies Act 2013 as their branches. Means these divisions are treated as branches. It follows that branch auditors appointed to conduct the audit of those divisions have the same rights, same obligations as those of the statutory auditors to whom they are expected to submit their report. So it's like branch audit, something that you would have seen in case of company wherein a separate auditor is appointed to audit a branch. So herein, because this division is nothing but treated as a branch, so the branch auditor will be appointed, and who will have all the rights, all the responsibilities, all the obligations which will be assigned to a statutory auditor, but his role is now limited to only that division or the branch. So as we can say, in case of private companies, so private companies means the private sector. So we are not talking about private limited companies. We are talking about public limited companies, but which are into private sector. Accounting and operational systems of the company are centralized, and hence principles of divisional offices preparing accounts and control, and they being consolidated is not applicable to such companies. They are generally maintained at the HO level. Okay. Now, as regards the directions of CAG, let's understand what are the directions. CAG has the power to direct the manner in which accounts shall be audited and give such instructions in regard to any matter relating to performance of functions by the auditor and to conduct. So what will the CAG do? He will have the power to give directions in regard to any matter regarding performance of functions. This is one. And so this is first. And conduct supplementary or test audit of accounts by such person as may be authorized in this behalf. So this is the second power of the CAG. Okay. The statutory auditors are required to submit a copy of their report to CAG, who has the right, means CAG has the right to comment upon or supplement the audit report. Next is about applicability of CARO. Additional reporting requirements under CARO will not be applicable to an insurance company. Why? Because they are excluded from the scope of reporting under CARO. Okay? Yeah. So let's move on to the audit requirements in general. And we also need to understand about this insurance company or this industry. See, insurance company or a company into insurance business will mean a company of a large size. Why? Because the company will put in 100 crore rupees as a minimum amount, without which they are not allowed to enter into this business. And any company which is putting in 100 crore rupees as the capital will definitely be considered to be a large company. Correct? Yeah. So that will generally be a large company. It will not be easy for us to say that it's a small company. Now, for a large company, if you look at the environment, or if you look at the internal environment of the company, if you look at the structure of the company, if you look at the processes of the company, and considering the nature of its business, which will involve numerous transactions, in fact, lakhs of transactions, because general public at large will be involved in the operations of this type of company. So that's why, considering the nature of the business, it is not possible for the company to operate in a manual environment. Company will definitely need to have automated processes. Means the usage of information technology will be significantly required by such type of companies. Otherwise, it may be very, very difficult for them to operate. And you may just think about the insurance. I'm sure many of you must have dealt with any of these insurance companies, maybe for yourself, maybe for any of your family members or otherwise. You must have dealt with them. And you must have seen their processes as to how they are operating. And you must have observed that most of their processes are automated. Most of their processes are based on information technology. Correct? Yeah. Now, considering this fact that the information technology is significantly involved in their processes, it will be very important, pertinent on the part of the auditor to get himself familiar with this information technology. He will have to understand the requirements of the IT environment. He will have to understand this complete IT environment in which the company operates. He will now not only limit his understanding to the manual systems, he will have to understand this complete system. Some of the processes which are working in an automated manner, he will need to have an understanding around it. Because without getting onto those processes, without getting into those processes the way they are operating, it will not be possible for the auditor to get into those audits. It will be very difficult for the auditor to plan his audit procedures. And not only plan his audit procedures, it will be very difficult for the auditor to do the risk assessment. Because the risk assessment which the auditor will do will also be based on the environment of the entity. And in this case, the environment of the entity is completely IT based. Yes or no? Yes or no? Now herein, it may happen that the auditor may need to engage some of his experts or some experts who will help him understand the IT environment, who will also help him understand the risks around the IT environment, and who will also help him to perform the audit procedures on that IT environment. Because without that, if he will limit himself to only the manual systems, then he will not be covering the significant part, or you can say he will be covering only the insignificant part. So that's why any of these auditors will now be requiring to understand, and accordingly will now be requiring to use their IT experts, or they will have to have that expertise themselves, and they will also be requiring to use the audit methodologies or the audit tools basis which audit of all of these information systems will be required to be done. You remember computer assisted auditing techniques, audit of an entity which is working in an IT environment. Yeah. So all of those procedures, all of those requirements on the part of the auditor will have to be considered now. Okay. So we can just now move on to the next part, that is about preparation of the financial statements. Now, in respect of insurance companies, we have discussed that there are certain specified schedules as around their financial statements, which comprise of balance sheet, P&L, receipt, payment, revenue account, all of these things. And there are specified formats actually which they are required to follow. Mostly they are required to follow the accounting standards. And all of these insurance companies are still not required to follow Ind AS. So Ind AS is something which has been deferred for all of these insurance companies as of now. And there's no clarity as of now as to when the Ind AS will become applicable to all of these insurance companies, or maybe some of these insurance companies. So that is still in process, yet to be clarified. So currently we understand that accounting standards will continue to remain applicable on all the insurance companies with certain exceptions. So let's understand that every balance sheet, P&L, the revenue account, the P&L, receipt and payment, cash flow of an insurer shall be in conformity with the AS to the extent insurers carrying on life insurance business, except that AS3 shall be prepared only under the direct method. AS17, that is about segment reporting, shall apply to all insurers irrespective of the requirements regarding listing and turnover mentioned therein. And then we can look at various components in the financial statements, which could be about premium, claims, liability for policies. We'll come to all of these points later, because all of these are nothing but the components. Now we can just quickly flip through the disclosure requirements. Disclosures which will be forming part of financial statements. One is about contingent liabilities, which is commonly known to us. Second is about actuarial assumptions for valuation. I'll come to this point separately because this happens to be the most important area of audit for any insurance company. Encumbrances to the assets of the company, commitments made and outstanding for loans, investments, fixed assets, amortization of debt securities, and various other disclosures, which you can just read through later on. Let's look at the accounting policies. All significant accounting policies as per the accounting standards and the significant principles and policies given in part of accounting policies, part 1 of the accounting policies, any other accounting policy followed by the insurer shall be stated in the manner required under accounting standards. Any departure from the accounting policies shall be separately disclosed with the reasons for such departure, and the impact should also be quantified in such a case. And then we can just look at a detailed list of all of these disclosures. Then there are various instructions around the preparation of financial statements, which is not really so much relevant for us because we are the auditors for which accounting knowledge is required, but we have a separate area through which accounting knowledge can be gained. Now let's move on to the audit of accounts of life insurance companies as to some of the aspects that we need to consider. Internal control functions have been categorized below under main operational cycles, considering the peculiar nature of life insurance business. Areas where internal controls are similar to the ones adopted by other companies, such as for cash and bank, receipts and payments, fixed assets, have to be dealt with as per the publications on internal control questionnaire issued by ICI. Since various operational cycles are interlinked, internal controls operating within the systems of such cycles should be reviewed simultaneously. So let's understand what are those peculiar processes. One is actuarial process. As I've been telling you, I'll come to this later. Underwriting. Now let's understand what is this underwriting process. A proposal is an application for an insurance cover. The process of verifying the level of risk in each new entrant is called selection or underwriting. So this underwriter assesses the risk and determines the premium to be charged. The function of the underwriter is what? To acquire or to write business that will bring money to the insurance company and to protect the company's business from risks that they feel will make a loss. The underwriters may either decline the risk or may provide a quotation in which the premiums have been loaded or in which various exclusions have been stipulated, which restrict the circumstances under which a claim would be accepted and paid. So what's the role of the auditor over here? While verifying the process of underwriting, he should review the process of acceptance of risk in the process of underwriting and evaluate the effectiveness of internal controls over here. Next is about reinsurance, free lock cancellation. So some of these things we'll discuss separately when we'll move on to some of the items of the financial statements, which we can start now. So now talking about the financial statements of insurance company. Now for an insurance company, let's understand what can be the key items or what will be the major items in its financial statements. If you look at the balance sheet, it will have various components like property, plant and equipment, loans and advances, liabilities. All of these things are generally seen, generally common. Cash and bank balances. But are those different from what we see in case of any other entity? No, they are similar, quite similar. So what are those things which will be different in case of an insurance company? Let's try to understand. One, that will be claim. Claims which are required to be paid by the insurance company. Because what will an insurance company get from a customer? So if you look at the P&L of the insurance company will get premium. We can say premium is the income. And similar to the principal income, you remember the principal income, the principal business, which we discussed in case of NBFC. We can say what is going to be the principal revenue generation or this principal income for an insurance company? Premium. Premium is what? That they will charge from their customers around the insurance that they will be doing for them. So in the P&L, the most important item for an insurance company would be premium. The second component is about the claim, which they will be required to pay. So against all of these premiums, what has happened? The risk has been passed on to the insurance company. So the customer has transferred his risk to the insurance company. And at some point of time, this risk may actually lead to outflow of money which will be in the form of these claims. Yeah. Now around these two things comes a very important point, and that is called as actuarial valuation. For an insurance company, unlike for any other entity, nobody knows as to what is going to be the payment of this claim. See, if you talk about a manufacturing company, they will know what are their liabilities and they will be having a certain amount of their liabilities. So that means the amount of liability is fixed. If you talk about an NBFC, just that we discussed, an NBFC will know if they have borrowed something, what is the amount that they are required to pay, because that is again fixed. But in case of an insurance company, do they know what is the amount that they will be required to pay every year? Is there any contractual arrangement with their customers on the basis of which they are required to pay a fixed amount to any of their customers? The answer is no. They do not know. It may have happened that they have got 1 lakh customers, and out of 1 lakh, they may be required to pay the claim amount to 50,000 customers in the next year. Or it may happen that they are required to pay claim amount to only 1,000 customers in the next year. This is uncertain. This amount is uncertain. This is not known. This is not fixed. There is no contractual amount which has been agreed between the insurance company and the customer. Correct? This is not known at all. So what do they do in this situation? Now in this situation, because this amount is not known, they are not certain as to what this amount can turn out to be. They will also not be very clear as to what do they charge from the customer, because the charges from the customer will be again based on the outflow. This is what we are calling this to be an outflow, or we can say possible outflow. This outflow is not certain. It's a possible outflow. It may or may not happen, which is based on some uncertain event, which is again not within the control of insurance company nor the customer. Both do not know. So now insurance company is stuck because they have to charge the premium. And now for charging this premium, what would they need? They would need to understand the possibility of happening of the event on the basis of which the claim will be required to be paid. Yeah, for which probabilities will have to be brought in. Means what's the chance of happening of an event, for which various assumptions will be required to be considered by them. For example, what has been the mortality rate? What has been the age groups of various customers which they have? What are the locations of the customers in terms of places where they stay? What are the activities into which they are involved in terms of the occupations? Means are they into activities wherein the health hazards are higher as compared to those wherein there is no health hazard or there is no chance of any health hazard in the future because of the works that they are involved into. So there are so many factors which are required to be considered by the insurance company. And that's why valuation of all of these amounts, or you can say measurement of all of these amounts, is the most complex area in case of an insurance company. And that is where they need experts for the valuation or ascertainment of these amounts. And those experts are called as actuaries. For an insurance company, you will generally see that they will be having in-house actuaries. Actuaries are the experts for the valuations around all of these types of outflows or the possible outflows. So these valuations, which are based on various assumptions, will be done by whom? A team of actuaries. Therein again, one actuary will not be sufficient. Something which you see in case of employee benefit. For gratuity, leave encashment, you may be thinking, sir, is it the same actuary? Yes, actuaries are same, but now their roles have changed. And we cannot say that just by having one actuary, they will be able to execute their processes. No, it will generally be a team of actuaries, and it is not required to be in-house team. It can be external or internal, or it can be a mix of both. But this function, or you can say this process, in case of an insurance company, happens to be the most critical one, on which auditor is also required to spend a lot of time, focus his efforts on, because on the basis of this, you can now understand some of the key components of the balance sheet, P&L will be based. So that's why auditor will also need to understand this process thoroughly. He will also need to involve his experts, because again, herein, without the involvement of experts, auditor may not be able to appreciate some of the methodologies which they have been following, some of the procedures which they may be following. So that's why involvement of all of those experts will be considered to be very, very important. Yeah. And on the basis of this, what will happen? All of these calculations of premium, etc. will take place. So now what we can do is we can just move on to certain important parts. So some of these things are repeated, so that's why I'm just skipping this part. So let's quickly look at this management report. Yeah, we can just understand some of the points around it. There shall be attached to the financial statements a management report containing following things or following information, which will be authenticated by the management. So this will also help the auditor in respect of some of his audit procedures. Confirmation regarding the continued validity of registration of this business. Certification that all the dues payable to the statutory authorities have been duly paid. This certification will also be made available to him. Then confirmation to the effect that shareholding pattern and any transfer of shares during the year are in accordance with statutory and regulatory requirements. Confirmation that the required solvency margins have been maintained. Certification to the effect that the values of all assets have been reviewed on the date of the balance sheet, and that in his insurer's belief, the assets set forth in the balance sheets are shown in the aggregate at amounts not exceeding their realizable or market value under the several headings which are given below. Certification to the effect that no part of life insurance fund has been directly or indirectly applied in contravention of the provisions of Insurance Act. Disclosure with regard to overall risk exposure and strategy adopted to mitigate the risk. Operations in other countries, if any. Operations in other countries, if any, with a separate statement giving the management's estimate of country risk and exposure risk and hedging strategy adopted. Aging of claims, indicating the trends in average claim settlement time during the preceding 5 years. Certification to the effect as to how the values as shown in the balance sheet of the investments in stocks and shares have been arrived at, and how the market value thereof has been ascertained for the purpose of comparison with the values so shown. review of the asset quality and performance of investment in terms of portfolios, separately in terms of real estate, loans, investments, etc. Okay, yeah. So this is something which will also help the auditor, because he can also get into some of these details which would have been considered to be prepared by the management. So now moving further, what we can now do is we can just look at some of the requirements of the auditor's report. Let us just quickly get on to those requirements. Yes. Apart from the normal contents of the auditor's report as prescribed for limited companies, IDAI has prescribed certain matters to be dealt with by auditors in their report as per IDA regulations. So the Schedule C is reproduced below. You remember Schedule C? Schedule A and B were meant for financial statements of insurance companies, for general insurance and life insurance. Yeah. And Schedule C was meant for audit considerations for the auditors in terms of their reporting requirements, which would apply to both life insurance companies as well as general insurance companies. So report of the auditor on the financial statements of every insurer shall deal with the specified herein. 1. That they have obtained, just give me 1 minute, that they have obtained that they have obtained all the information and explanations which, to the best of their knowledge and belief, were necessary for the purposes of their audit, and whether they have found them satisfactory or not, which is a general declaration which anyways they will be required to do. Whether proper books of accounts have been maintained by the insurer so far as appears from the examination of the books. So you can see that it's a specific kind of declaration which is required to be given by the auditor. Whether proper returns, audited or unaudited, from the branches, other offices have been received, and whether they were adequate for the purposes of their audit. Whether the balance sheet, revenue, P&L dealt with by the report, receipt and payment account are in agreement with the books of accounts and returns. Whether the actuarial valuation of liabilities is duly certified by the appointed actuary, including to the fact that assumptions for such valuation are in accordance with guidelines and norms, if any, issued by the authority and or actuarial society. Something which is considered to be an extremely important area in case of audit of insurance companies, as I have just discussed with you, and which is subject to a lot of assumptions. So you can also say it's an estimate. Then auditors shall express their opinion on. Now what is it that they will express their opinion on? Financial statements comprising balance sheet around its affairs or statement of affairs as at a particular period. Whether revenue account gives true and fair view of the surplus for the financial period. Whether P&L gives true and fair view of the P&L for the financial period. Whether the receipt and payment account gives true and fair view of the receipts and payments for the financial period. Okay. The financial statements which are stated at A above are prepared in accordance with the requirements of Insurance Act. You remember, Insurance Act is what we started with. IDA 1999, Companies Act, which is now Companies Act 2013, to the extent applicable and in the manner so required. Investments have been valued in accordance with the provisions of the Act and the regulations. So all of these things are required to be specified in the audit report. Accounting policies selected by the insurer are appropriate and are in compliance with applicable accounting standards and with the accounting principles as prescribed in these regulations or any order or direction issued by the authority in this behalf. The auditor shall further certify that. So within the report, they will further certify that they have reviewed the management report. You remember the management report, the clauses, all of those points, and that there is no apparent mistake or material inconsistencies in that report with the financial statement. So it's like similar to reporting on other information that we saw in case of a company in the main report. And insurer has complied with the terms and conditions of the registration stipulated by the authority. Then a certificate signed by the auditors, which is in addition to any other certificate or report which is required by law to be given with respect to the balance sheet, certifying that they have verified the cash balances and securities relating to insurers' loans, reversions, life interest in case of life insurers and investments. Life insurance investments, the extent, if any, to which they have verified the investments and transactions relating to any trusts undertaken by the insurer as trustee, and no part of the assets of the policy holders' funds has been directly or indirectly applied in contravention of provisions of Insurance Act. It is clear that the auditor has to examine, auditor should examine contents of the management report, which is similar to other information, with a view to clarify that there are no material inconsistencies, and to certify there are no material inconsistencies with the financial statements. The auditor should, based upon the audit conducted and the information and explanations which are gathered by him during the course of his audit, verify that there are no material misstatements in the management report. Verify there are no material misstatements in the management report. Okay. As far as certification of compliance with the terms and conditions of the registration stipulated by the authority is concerned, the auditor should ask for relevant documents from the management of the company and conduct an examination thereof. Obviously, based on his observation, auditor should certify the aforesaid compliance. So that means around all of these compliances, around all of these testing, if auditor will require any sort of document to be tested, he will ask the management. And that is important, because if he is looking at this report and he needs some clarifications, he will discuss with the management. He will have inquiries. And in case he wants to look at any document to clarify some of the points in relation to any of the procedures that he might have planned or he may plan to adopt, then he can get onto those documents, review those documents to ensure that there is no inconsistency and there is no material misstatement. And again, in this case, he'll have to ensure that there is no material misstatement in that other information or in this set of financial statements, because only then he will be able to ensure that there is no material misstatement in the financial statements. Because otherwise, either the inconsistency will stay or the material misstatement will stay. If both of them go out, only then the financial statements will be considered to be not materially misstated. Okay, yeah. Moving further, the auditor also has to state in the report that the reliance has been placed on the certificate obtained from the appointed actuary in respect of various reserves which are certified by the appointed actuary of the company. So now what is it that the auditor has been doing? He has been placing reliance on the certificate of the actuary. Correct? Yeah. And he is putting that down in his report clearly. It's a very specific declaration which he has been giving in his report. The auditor also has to issue separate certificate. You remember we discussed about it? He has to issue separate certificate on verification of cash. Issue separate certificate on verification of cash, checks in hand, and other securities. Why? Because these are considered to be another important component in the financial statements or in the balance sheet of any insurance company. So that's why auditor will be required to focus on these items. Auditor will be required to not only audit these items, but a separate certification is required to be given. And in this case, considering that a lot of information is required to be analyzed by the auditor like this, a lot of certifications which are required to be given by the auditor, and considering the peculiarities which are involved in this business, auditor may also require specific representations from the management, which will have to be analyzed by him, which will have to be understood by him as to which all specific representations he would want to take. And all of those specific representations will form part of his management representation letter, which he will take from the management. Yeah. So similar to any other audit, what will happen in case of insurance company? That means in case of audit of insurance company, at the time of signing, he will also obtain management representation letter, which will cover all of these aspects about the financial statements, means as to what has been the basis of the financial statements in terms of preparation by the management, whether all of these regulations, whether all of these compliances were taken care of by the management, because it's now not only limited to the financial impact, but it's also about various other informations, various other certifications which the auditor is required to do. So that's why at certain places, if the auditor requires, he may also call for specific representations from the management. For example, some of these certifications that he's been doing, so over and above that representation letter, he may also want a specific representation from the management. So even though that point is appearing in the management representation letter, it will be considered to be a separate or specific representation from the management, which is again commonly done by the auditors depending on as to how they plan all of these things. Okay, yeah. Moving on to the next point, just 1 minute. Moving on to the next point. Then the Insurance Act provides that accounts and statements should be signed in the case of a company by the chairman. So we are looking at signing of the accounts, or you can say the set of these financial statements. And who will sign this in the case of a company? By chairman, if any, and two directors and principal officer of the company. So it will be signed by chairman, if any, and two directors, means 3, and the principal officer of the company, 4 persons. Okay. It further provides that accounts and statements should be accompanied by a statement containing the names. So what will be included along with all of these accounts and statements? Accompanied by statement containing names, descriptions, occupations of and directorships held by persons in charge of management of the business during the period to which such statement refers, and by a report on the affairs of the business during that period. So these are some of the statements which will be accompanied along with these accounts and statements which will be signed by the chairman or the directors. Now, as regards this, what will the auditor do? Now the auditor will also be required to verify all of these information. Correct? Because in terms of the signing, he cannot just say that anybody can come in and sign. So there are again regulations around it. So auditor will also have to look into those regulations. Auditor will also have to check all of these persons. First of all, whether as per the law, they are the authorized person for the signing or not. And in case, if he is looking at the details of all of these persons, auditor should also verify, which in any case he would have done. If you look at most of these persons, they must be the KMP, key managerial personnel, which in any ways auditor would have looked at, he would have reviewed, he would have analyzed as to whether they are KMP or not, and what is really their designations. Are they the directors? Are they the principal officers? Are they the chairman? But for all of these things, auditor will have to go through the underlying documents, and he can easily track all of these details from the secretarial records. He can also look through some of these information from the list of related parties also, because most of them will be considered to be the key managerial personnel for any company. So that's why that can also be one of the ways to track it. But as around the information around their descriptions, occupations, directorships which are held by them, auditor will need to look at the supporting documents. He will need to verify those supporting documents, and post their verification, again in this case, what is going to be the most important part? Audit documentation. So audit documentation, like for any other audit, will also be important over here, and particularly for these type of companies wherein the regulations are so stringent, which are so stringent for the entity, will also be stringent for the auditor. Auditor will also be subject to various reviews. Remember, we discussed about peer review, quality reviews. Yeah. So all of those reviews will really be relevant over here. So that's why all of these things which will become audit evidence, you remember audit evidence, will have to be properly documented by the auditor of the company. All right. Yeah. These are the things which you need to understand in relation to an insurance company. But again, for an insurance company, you must not forget, like we've just discussed, that be it any type of business, be it any type of entity, the only thing which can change is about the nature of the business or the compliances which it may be required to do. The basic audit approach for any type of entity will always remain same. And what is the basic audit approach? To look at 4 stages: planning, execution, conclusion, and reporting. So that will apply everywhere, right? So with this, we can conclude our session over here, and you have had this back-to-back sessions. So I'm sure you must be over with some of these things, but I'm hoping that you are enjoying the sessions, and we are also having one session tomorrow evening wherein we plan to start another chapter, and I think with that, most likely we'll also be able to conclude our discussion. Okay. Yeah. So with this, I would just like to thank all of you once again for your time. Thanks so much.